What's ahead for our property markets for the rest of the year? Now, that's a common question people are asking now that our property markets have been booming for quite some time. And that's the question I'm going to ask Dr. Andrew Wilson, Australia's leading housing economist, in today's show. We're also going to hear his thoughts on what's ahead for the rental markets. Is inflation on the rebound? And should we be locking in interest rates with the speculation that interest rates are going to rise? Now, you probably know that every week I record a Property Insiders video with Dr. Wilson where we give you our thoughts, the thoughts of two grey-haired men who've been around the market for quite some time, and we give you a commentary on the property markets and the economy. And today's podcast is the audio of last week's video show. Now, if you were to watch the video, there'd be a number of charts that explain what we're talking about, and you can catch that on our YouTube channel at propertyinsiders.info. But there's so much great content, so much good information that Andrew is going to share in just the audio session today that I'm sure you're going to get great value and some clarity on what's ahead. So welcome to today's show.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Well, we're into June and the last 5 months have been like no other. In fact, if you look back, the last couple of years have been like no other. Only last year, Australia experienced a tragedy which was unevenly distributed, an economic freeze and a media frenzy. Then this year, our economy rebounded. Almost all the jobs that were lost have been replaced, and our property markets defied all the doomsayers. So what next? Well, that's one of the questions I plan to ask Dr. Andrew Wilson, Australia's leading housing economist and chief economist of My Housing Market, and I look forward to hearing his beginning of the month update on what's happening in our property markets and our rental markets. Hello, Andrew.
Yes, hello, Michael, and onwards and upwards and onwards and upwards.
Well, our property markets have been bounding along this year. Buyers are out and forced owner-occupiers, investors and first-home buyers at a time when availability of new supply is struggling to keep up, and that's, of course, pushing prices higher. In fact, a number of capital city property markets are already showing double-digit capital growth this year alone. But as always, Andrew, let's start with what's happening in our auction markets, because that gives us a good in-time indicator of what's happening on the ground.
Yes, look, certainly auction results are a window into the broader housing market activity levels, and we saw again on the weekend what we've seen for the month of May, and that was another flood of listings coming in. No sign of listing numbers really easing, Michael, even though we are heading into the typically quieter mid-year selling season. Another very big weekend, and it just capped off what's been a record May for auction listings across the board, not just nationally, but obviously in Melbourne and Sydney. Have never hosted the number of auctions in a May month in history. So it's remarkable just how many sellers are continuing to be prepared to engage the market. But what's really remarkable is that despite that week in, week out flood of listings over May, clearance rates really haven't tumbled at all. They've eased slightly, and so they should, given all the extra choices that buyers have now. But clearance rates were still above 80% everywhere except in Brisbane and Melbourne. Melbourne's eased down a little bit, but look, it's had 1,100-1,200 auctions every weekend over May. So coming back into the middle high 70s, I think is no disgrace.
Andrew, especially if you're locked down and you've either got to bring auctions forward or about 200 were withdrawn, weren't they?
Well, that's right. There was really no blip in activity. And I think that's the point, that memories are long in terms of what happened last year. And even though we had severe lockdowns in Melbourne, the property market continued to transact at lower levels. But once the shutdown restrictions were eased, the market was quickly back up and running again. And I think there's even a greater anticipation of that, particularly given how strong the market has been this year, and that any doubts about the underlying strength of not just the dynamics of the housing market, but also the economy are certainly nothing that are concerning buyers and sellers. So once the inconvenience of the shutdown is behind them, they will get back into the action. But there was really no impact over the first weekend of the shutdown, other than the draws that we typically see, which were above 10%. But the actual clearance rate was still held up just a little lower than the previous weekend. And no surprise, we've also seen auction prices rising over May compared to April. April was that typical holiday month. And in fact, we had a real hiatus during April in terms of auction numbers, not surprising. And that also means that a lower proportion of higher priced properties are in the market over that holiday month. And so when we bounce back, as we have in May, with a higher proportion of higher priced properties, we get that effect of prices growth. And that's just accentuating what is underlying prices growth anyway. But a very big month of May, Michael. No sign of the market slowing down, even though we're now into June. We have the Queen's birthday weekend in a fortnight, and then we really should see an easing due to those mid-year holiday distractions. And theoretically, we get a quiet July and then start to build again in August for the spring selling season. But the way this market is going, I think it'll just shift from fourth gear down to third gear at the moment.
And moving forward, the market has got all the underlying fundamentals still of the interest rate drop hasn't really worked its way through the cycle. Some of the pent-up demand has been taken up, and there also seems to be a little bit of buyer fatigue. People are getting a bit of sick of missing out at auctions, missing out at private sales, but there's still enough depth in the market, Andrew, for this to continue for some time.
Well, even though we had record numbers of sellers over May, Michael, in the auction market, and that would reflect generally in the broader market, we've had a record number of sales. So the point is that the level of the flood of listings into the market over May has really not tested buyer depth. Buyer depth is still standing up. So the question is, when will we start to see a significant reduction in buyers that have either satisfied their demands or are being priced out of the market? But at the moment, buyer depth is holding up with this flood of listings coming in. But I can just perhaps add to that, Michael, that even though auction listing numbers have surged over May, over the last 3 weekends, we have seen reduction in new listings. That's total new listings coming into the marketplace. So that's a clear sign of the winter hiatus coming upon us. I think we've got to understand that these auction numbers are reflecting decisions that were made 6 weeks ago. So the current decision-making by sellers is certainly showing us a slowdown, as we would expect. So that will flow on into the auction market. So I think we're still going to see that seasonal decline in seller activity coming through. We're seeing clear signs of that generally now, but buyers still have quite a solid appetite for whatever property is being offered at the moment. In fact, solid, I think, is understating it.
I think it is. We're noticing two things on the ground. There is still FOMO. People are worried about the market moving faster than they can catch up with it. And that's creating some buyers to make some poor decisions, emotional decisions. They're buying on the rebound because they missed out on last week's auction. They're not doing all their due diligence. They're cutting corners. They're maybe looking at inferior properties, and that may catch up with them moving down the track. The other thing is we're noticing people are saying, okay, I can't buy in that suburb, so I'm going to move. And the ripple effect is starting to take effect where people are getting realistic about what they can buy in today's market just to get in.
Well, that's what we typically see, of course, Michael, the rise of the bridesmaid suburbs. We'll see that occurring now. But the interesting part of this cycle, and it is completely different to other cycles, and we should always recognise that is what happens, even if some of the differences are subtle from cycle to cycle. This is quite a significant change in what's happening, and that is that we haven't seen investors active in the market until now, but we certainly are seeing a rising appetite from investors. No surprise there. And that's likely to keep the market ticking over, particularly through the midwinter, because midwinter buying, because there tends to be less competition, can be a good opportunity for purchasers. And I think that we'll see continuing growth in investor activity in that higher yielding, lower price point in the market through June and July.
Now, Andrew, while our housing markets have been performing strongly around Australia, we know the rental markets have been fragmented, with certain sectors performing strongly and others languishing. Now, I know you watch the rental markets carefully and you bring out a monthly rental report.
Yes.
So what have you found happening around Australia in our rental market?
Well, this must be of concern to tenants generally, Michael. We are seeing continued fall in vacancy rates. Vacancy rates are very low now. Most vacancy rates for both houses and units, and of course my housing market produces a vacancy rate for both houses and units in each of our capital city markets uniquely. But we are starting to see even the Melbourne and Sydney markets, which have been characterised, their unit markets, with high vacancy rates, in fact record vacancy rates in Melbourne and Sydney, which were a result of the COVID shutdown, as well as a lot of supply coming into the market over recent years with the apartment building boom. But that was really exacerbated by the border shutdowns, with a real lack of demand coming through from particularly students, of course, in those areas, which are particularly Melbourne, which are targets for overseas students renting. The other main change was increased supply from Airbnb. And we saw a flood of Airbnb, which are normally short-term holiday and accommodation tenancies, move into the long-term permanent market as a result of the shutdown, with no, of course, international tourists, and the state shutdown as well. So Airbnb switched over. So we had less demand and more supply, which gave us record vacancy rates and rents falling. But we're seeing a reversal of that now, Michael. Clearly, vacancies in both Melbourne and Sydney apartment markets have fallen. In Melbourne, it's down by 10%. In Sydney, it's down by 5% over the past month and continuing to fall. It's still quite high, the vacancy levels, and vacancy rates are still high, but they've come down quite sharply over the last month. And I think that'll act to put a floor under what's been a steep decline in rents. But I think we shouldn't be surprised at that. We are starting to see, I guess, more of a normal churn in apartment tenancies. People are up and about now, less concerns over the economy. They're starting to activate those tenancy decisions that were perhaps put on hold over the shutdown period of the last year. As I said, the economy's doing better. So people are now looking, perhaps those early stage tenants are looking for their apartment to lease and attracted by lower rent. So that's one part of the increased demand. Of course, we are starting to see fewer first home buyers in the market because prices are squeezing them out, higher prices. So they'll be, again, increasing demand for tenancies. So there's two increased demand sources. And of course, the fact is we now have, well, until last week, we had our borders opening up, our state borders opening up. So travel for tourists and businesses has started again. And I think that's helped to take the Airbnb short-term accommodation back to what it was doing, offering short-term accommodation to business travellers and tourists, and taken away from the permanent market. So that's now an adjustment process that's underway. Of course, we need to keep our borders open, and that is slightly problematic at the moment, Michael. But there's no doubt that that part of the market, which was the underperformer compared to other parts of the market, is now heading back to perhaps a more normalised environment. But the rest of the market, Michael, and we're talking, of course, about houses for rent, is very, very tight at the moment. In fact, we started to see a bit of a blip upwards recently in houses to rent in Melbourne and Sydney, but that's reversed itself now. Vacancy rates in Sydney for houses are now under 2%, and they've fallen in Melbourne. I think part of that vacancy rate issue in Melbourne of it increasing was that we did have a sense of interstate migration, a movement out of Melbourne to perhaps northern states as a result of COVID issues. And maybe that'll reassert itself. But I think that was starting to adjust because there is an underlying shortage of rental accommodation in Australia, Michael. To see broadly vacancy rates below 1% is really a concern because it'll mean higher rents, it'll decrease rental affordability. And it has been driven fundamentally, I believe, by the lack of investor activity in the market over the last 4 years due to those credit squeezes that were enacted on investors. And of course, part of that drove itself into low building numbers. And even though we've bounced back with the home builder policy, last year, and building numbers are quite high, but they're fringe houses that are being built. Overall, our dwelling approval numbers are still well below the peak of 4 years ago. And this just, again, with a lack of investor activity, although it's picking up now, has meant an undersupply of rental properties. And that means higher rents, lower vacancy rates. And there's really no sign of an adjustment in the short term here. So I think this is of deep concern to a balanced housing market. And I don't think it's the solution there for many tenants is to just go out and buy a house, given how prices are skyrocketing at the moment. It's really moving beyond those in, I guess, lower income levels.
You can see moving forward there's going to be a shortage of apartments because there aren't many cranes in the sky. And the other thing is there's a long lead time for that. And as our markets move on and millennials feel more comfortable, some of them are now going to go back to moving out of their parents' home back into family formation stage. Yep. So the millennials are going to be the drivers of the next stage of the property market.
Yeah, look, it's, as I said, to be in this point where we would likely see more demand as the house price cycle, that is first home buyers, start to be eased out of the market. And we're already in a position in most of our capitals, and that's the exception still apartments, inner city Sydney and CBD Melbourne. They're still the exceptions, but they're heading now more towards a balance between demand and supply. And we're going to continue to see upward pressure on rents. And house rents, Michael, have increased in most capitals by double figures over the last 12 months, which is quite extraordinary, and some pushing towards 20% annual increases in house rents. And I think the Brisbane market in particular, and other markets, Adelaide and Perth, are being confronted by higher levels of migration, which the first port of call typically is the rental market, which is acting really to push rents through the roof at the moment.
Well, rents are going up and so are property values, but there's lots of other factors to take into account when you talk about inflation. But Andrew, in the media recently, they seem to have been trying to talk up or scare us that inflation, the boogeyman's coming back.
Well, the relationship is obviously with interest rates. There, Michael, we know that higher inflation eventually leads to higher interest rates. Central banks want to quell inflation to avoid the wages prices spiral that we have seen through strong growth periods. So they're always ready to push the button. But we are so far away from that circumstances. It's just almost ridiculous to be contemplating it. We will see some adjustments to inflation over the coming 6 months or so, Michael, because we are moving out of an artificial inflation environment where, because of income support and price support, we've had inflation down to record low levels. They're already at record low levels, but even lower than that they were before COVID. And we will see some adjustment as those support packages ended and we get back to more of a normalised position. We will see upward pressure on building costs, of course, in particular when that building surge gets out of the ground from the home builder package, and that will work its way into inflation. Other factors such as the subsidy on child care packages is now being normalised, so we'll see childcare rising. We're seeing higher fuel costs, Michael, and now the price of oil is starting to move upwards. So these will work their way into higher headline inflation over the next couple of quarters, and we will get the screaming headlines telling us that all this means higher interest rates are just around the corner. That is nonsense. Underlying inflation remains at record low levels. That is, it takes out the volatility in the series, the headline series. And there's really no prospect for that rising, particularly given the Reserve Bank starts to look at higher rates once we start heading towards 3% inflation. We're half that at the moment. And of course, the key is not so much inflation, but an incomes growth is still very, very low. We need an unemployment rate of 4, maybe 3% something to get incomes up to where they were back when we increased interest rates last, which, hey, was 10 years ago. And that's when we had 4% incomes growth. So it's a cheap headline, Michael, a really cheap headline that inflation will drive up interest rates. I think the Reserve Bank would be pretty comfortable with its prediction that they won't be considering rises until perhaps 2024. And even that's highly speculative. Again, I repeat, we haven't had an interest rate increase in Australia, official interest rate increase for 10 years. And when we did have it increasing, we had incomes growth of around 4% per annum. We are light years away from that. But getting it wrong on inflation will just add to the other factors that have been mistaken by pundits in terms of deep recessions, depressions, house price crashes, the cliff, and now we have inflation. So it goes on, but it's just good stuff to wrap your fish and chips in.
Well, it's not only the media, because the banks are now recommending that consumers fix interest rates. While variable rates are low, long-term 3 and 4 year fixed rates are starting to creep up a little bit, Andrew. What are your thoughts on that?
I'm very cynical about this, Michael. We know that low interest rates really do chop into the margins of banks. They are a business like any other. They want to maintain their profitability, and when margins are falling, they need to figure out ways of improving their bottom line. One of the mechanisms they use is to try to switch when we know that variable rates are going to remain flat for the foreseeable future. Just ask the Reserve Bank Governor, which I completely agree. But we know that they will look to other products, and that is the fixed loan product. I saw an advertisement the other day, Michael, that was asking consumers to consider that perhaps they could get off the roller coaster ride of interest rates, which of course we have had, and that therefore locking in an interest rate might be something to think about, a fixed rate for the next 2 years. Well, the Reserve Bank has said it's going to be at least 3 years since that they'll raise interest rates. Now, they could be wrong, who knows? But I do think it's a little bit of a cynical exercise to be speaking about the roller coaster ride, the implication for interest rates, when we know that interest rates now are dead and buried for the foreseeable future. The genie's back in the bottle. And perhaps it's a question we could ask of the senior or chief economists of those banks that are promoting a fixed rate on the basis that there will be a short-term increase in official rates, whether or not they actually support that position. I would be interested to see what the reply was. I think I know what it would be, though.
So do I. Well, at the beginning of our chat, I said I was going to ask you what's next. You've told us what's next with our property markets, with our rental markets, with interest rates, with inflation. I think we're finishing off with a really good understanding and a bit more clarity. So I look forward to our chat again next week, Andrew.
Yeah, thank you, Michael, and welcome to winter.
Yes, yes. Well, a moment ago you heard Dr. Andrew Wilson's view on what's ahead for our property markets. And while they may slow down a little bit, we've still got a lot of momentum there with the pent-up demand, the strong depth of buyers wanting to buy new homes, upgrade their homes. So we've still got quite some time ahead, and our research seems to suggest that that's going to continue on into much of next year, when this complete cycle will deliver 25 to 30% growth in property values over the whole cycle. Now, some properties are going to go up in value more than others, and that's why it's going to be important to own the right properties. You also heard Dr. Andrew Wilson's view on rents, and they're on the way up as well. And inflation will creep up a little bit, but not enough to scare anybody, and interest rates are likely to remain low for a while. Well, that's Andrew's views, and he's been pretty right up to now, and I happen to agree with him. We don't always agree on everything. We don't see eye to eye on everything, but I think the fundamentals point in those directions. And of course, twice a week I'll be giving you my thoughts on what's happening in the property markets in this podcast. By the way, there's some other ways you can get information about property as well. I've got a special bonus for you as a listener to my podcast. Just go to podcastbonus.com.au and you can get a bundle of books and reports, ebooks and reports that'll help give you some further background about property. Now, as I started to say, this cycle has still got quite some legs to it, and on that basis, it's not too late to get into the property market, but not all properties are going to increase in value similarly. Some will do much better than others, and that's why you need to get guidance, direction, and certainty of getting above average rates of return on your property investments. And that all starts by putting a plan together, because what's a good investment for me at my level of investing isn't necessarily the right investment for you. And you can trust my team at Metropole to provide you with direction. What we do is always start off by putting a strategic plan together. Hey, you can go to metropole.com.au and find out about what my award-winning team can do for you. And once we put a strategic plan together, we'd love to help you by using our buyer's agency to source properties. And we help investors, beginning investors, experienced investors, and home buyers as well. We've got a wealth advisory division, financial planning, property management. We've got a range of services to help you. And all you'd have to do is go to metropole.com.au, find out about what we do, and I look forward to being part of your ongoing wealth creation journey. I'd like to run a little quiz. It's been estimated, it's been suggested that there's going to be 25 million of these by 2100 at the end of this decade, 80 years' time or so. 25 million what by 2100? Take a guess what I'm talking about. Is it electric vehicles? Maybe household robots? Could be wild elephants, centenarians, or streaming services per household. Let's have a look. Okay, electric vehicles. Well, I think there's going to be many, many more than 25 million. Estimates suggest there's actually going to be 145 million electric vehicles on the road by 2030. Maybe there'll be 25 million household robots. Well, we know that domestic robots, they offer all sorts of things now, don't they? Not just lawn mowing and vacuuming and mopping, but even companionship. So it's estimated there's probably going to be about 55 million domestic bots sold next year alone. Okay, so is it going to be the population of wild elephants? Well, from 1989 to 2018, the number of elephants in the wild doubled to 34,000, reported by earth.org. So no, it's not going to be wild elephants. Maybe it's going to be streaming services. Well, currently, we've got Foxtel, I've got Netflix, I've got Amazon Prime. So most households apparently have got 4 streaming services. Sure, there's room for growth, but there's not going to be that many. You know what it's going to be? There's likely to be 25 million centenarians. The world is in the midst of a longevity revolution, and by 2100, there may be as many as 25 million people aged 100 years or older around the globe. And that's according to sources cited by Science Direct. The world's 65 and older population is growing rapidly. Hey, I'm over that age, so I'm happy about that. According to the most recent population estimates from the United Nations, they suggest that 1 in 6 people in the world will be over the age of 65 by 2050, and that's up from 1 in 11 in 2019. The latest projections also show that the number of people aged over 80 is going to triple in the next 30 years. The number of people aged over 80 is going to triple in the next 30 years, and in many regions, the population aged 65 will double by 2050, while global life expectancy beyond 65 is going to be increasing by 19 years. So, my message to you is that longevity, the fact that you're going to live much longer, deserves probably more thought than it currently receives. It's obviously an essential part of every financial and retirement plan. How long do you need to live off your assets? And we know you can't count on the government and the pensions to support you in your retirement. So what I've just mentioned to you should influence your saving goals, your investment choices, and your retirement income levels that you're planning for. And you've probably heard me say in the past, you need much more money. You're going to need much more money to enjoy your golden years than you most likely estimate. Once you retire, you're going to be experiencing the longest holiday of your life. So you should have enough money to enjoy it. Yet many people often underestimate their potential longevity. So on average, in good Western countries, people are living around 84 years of age, but that means that's an average. So if you're 65 now, you've got a 50% chance of getting to 84, but you've also got a 50% chance of living longer than 84. So my message to you is, when it comes to planning for your future, have above average expectations for the longevity, and also understand if you're going to be using property as a vehicle for your financial future, what sort of properties are going to be in continuous strong demand then? Look, if you think about it, you may be buying a property today that's, 20, 30, 40 years old, and you're going to retire in 20 years' time. That property will be, 50, 60 years old. And then you're going to want it to work for another 40, 50 years. It's going to be 100 years old. That's one of the reasons I'm not suggesting you buy 100-year-old properties now that are going to be 150 years old when you're in your retirement years. So a lot of thought has to go into what's the sort of property that's going to be in continuous strong demand and the locations that are going to be in continuous strong demand, not just now and next year, but over the long term to secure your financial future. I started this show by explaining I'd give you some insights into what's ahead for our property markets moving forward, and I hope my chat with Andrew Wilson has given you a little bit more clarity. And if it has, and you know somebody else who'd like to know what's ahead for our property markets, why not tell them about the Michael Yardney podcast? My aim is to make as many Australians and people from all over as financially successful as possible, and in particular through property investment. So tell somebody who you think would also benefit, or why not tell the world by leaving a podcast review, because the more reviews we have, the more people seem to find out about us, and let them get the great information as well. You can catch me in between these twice weekly podcasts on social media. Just look for Michael Yardney, or join my private Facebook group where every day I leave a couple of snippets. I leave you some charts or some commentary or something I don't leave elsewhere that's in time, that's relevant to what's happening. Just look on Facebook for the Property Update Facebook group. I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?